So, but yet the banks are short hundreds of millions of ounces, and they're feeling the pain today. And I know that for a fact. So we have to take advantage of the current metal prices, which we do and are doing right now. But it's interesting because the bank limits that a lot of these traders have hit their limits. As a miner, the gold producers and silver producers out there, they're having issues selling metal at current metal prices because all the credit limits are all at their limits throughout the entire banking system. On the supply side, we haven't seen any new supply, and I don't see any new supply. I see less supply.
In today's episode, Keith Neumeyer, CEO of First Majestic Silver, a major player in the silver industry, voiced concerns over the unrestricted ability of banks to short sell vast amounts of silver. Neumeyer highlighted the lack of regulatory limits on the quantities that banks like JP Morgan and HSBC can trade, which he sees as a significant risk to market stability. According to him, banks can and do manipulate the market on a massive scale merely at the click of a mouse. This unchecked power, he argues, has profound implications not just for investors, but for the silver market as a whole. Neumeyer went on to describe the current state of the physical silver market, which he claims is closer than ever to a critical shortage. Despite regular assurances from exchanges that the supply squeeze is temporary, Neumeyer painted a picture of a market teetering on the brink of a real crisis. This precarious situation is exacerbated by geopolitical tensions and increased nationalistic policies, where countries are increasingly keen to repatriate their precious metals, further straining global supply chains. The conversation also touched upon the broader challenges facing the silver mining industry. Neumeyer pointed to systemic issues such as a decades-long neglect in exploration and development of new mines. He specifically noted the arduous and prolonged permitting process that new mines face, citing a personal example where a discovery made in 2010 is still years away from obtaining the necessary permits to begin operation. This bureaucratic inertia, he lamented, hinders the industry's ability to respond to growing market demands and contributes to the declining production figures seen worldwide. Now we'll show you the best clips of his latest interview, but first smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
So, but yeah, the banks are short hundreds of millions of ounces, and they're feeling the pain today. And I know that for a fact. We deal with the physical market, and yet as a miner, we sell our ounces, and we have to sell our ounces because we're not in the business of hoarding our own ounces. Our institutional investors expect us to take advantage of the current metal prices, and they want to see those revenues and those profits, and that affects the analysts, and that affects the target prices they put on our stock, and that affects the shareholders who own. We have 80,000 shareholders worldwide. If all of a sudden we have no revenues, then that's not going to be very good for our share price. So we have to take advantage of the current metal prices, which we do and are doing right now. But it's interesting because the bank limits that a lot of these traders have hit their limits. Which I remember going back to 2011, the same phenomenon occurred, but it was so long ago that I kind of forgot about it. But now, as a miner, the gold producers and silver producers out there, they're having issues selling metal at current metal prices because all the credit limits are all at their limits throughout the entire banking system. Because there's a delay from the time we sell our ounces to the time we actually deliver the ounces. And that could be a 30-day delay, it could be 60 days, it could be 90 days. And that difference is financed. And the banks finance that on behalf of the mining sector. And that's a relationship that's been going on for decades and decades and decades. And that's just the way it works. Yet now, those limits have come to numbers that have reached a breaking point. And I'm going to spend some time on this topic over the next couple of months and see what can be done from a mining business perspective to see how we can avoid such things in the future. One of the things we have done is open our own mint so we can pull silver out of the banking system. We could talk further about that. But Dunnigan, your question was also on the supply side. I think you had about 10 topics in your preamble, which I should have had a piece of paper in front of me and wrote them all down. But on the supply side, we haven't seen any new supply, and I don't see any new supply. I see less supply. So if you look at Coeur d'Alene's or Coeur Mining's production numbers, you look at First Majestic's silver production numbers, Pan American silver production numbers. Silver production is dropping worldwide, and there's all kinds of reasons for it. We can have maybe when I see you in Florida, we can have a beer together, and I can explain all the different nuances that go on in the mining sector. But permitting is the biggest issue, and that is getting more and more difficult. Countries around the world are more reluctant to permit mines. We're trying to get silver on the strategic metals list. I remember watching an interview from Pierre Lassonde about, I guess it was about 2 years ago, and he said on this interview that he was called up by the mining minister of the province of Ontario here in Canada, and the minister asked him, how do we produce more metal? And Pierre Lassonde was blown away. He said, "What do you mean? How do we produce more metal? You give us permits so we could produce more metal." And this minister of mining had no clue, right? So if Mexico wants to loosen up their permitting, or Nevada or Arizona, or Canada, where most of these metals come from, we could produce more metals as an industry. But for the mining sector, and I'm the chairman of a company called First Mining Gold, which many of your listeners probably are familiar with. We've been working for 7 years on a permit. The asset was discovered in 2010. It's now 2024, 14 years after discovery, and still hasn't got a permit. We're not expecting a permit for probably the next 2 to 3 years. And that's if everything goes smoothly. So the burn rate on that permit is about $20 million a year. So over that 20-year period, it costs around $300 to $400 million just to get the permit. Then you have to break ground and build the mill, which is going to be another $600, $700, $800 million. So how long is it going to take you to get payback on that? So institutional investors, they don't have the patience. So you go to an institution, say, "Hey, I want $50 million. I'll pay you back in 20 years." They're going to laugh at you. So it's a very difficult industry, very tough to raise money for, and it's a long game. And you have to have patience as an investor, but you have to have patience as a management team. And at First Majestic, I think we've proven ourselves over the last 20 years. And but it is a big challenge. Talking about silver, talk to the governments and ask them the question: why don't they put silver on the strategic metals list? If they did, then maybe governments would wake up and say, "Hey, look, we need this metal, and we're going to fast track permitting. And rather than taking 20 years to get a permit, we'll do it in 3 years." And if they did that, then we could potentially get silver ounces produced, or more silver ounces produced on an annual basis.
In today's market recap, Wall Street throws in the towel on gold after Friday's rout. Main Street optimism likely a pre-sell-off snapshot. This week, precious metals markets saved all their drama for the grand finale. Spot gold opened the week trading at and spent much of the first 4 days trading in a relatively narrow $25 range. The expected 25 basis point rate cuts from the ECB and the Bank of Canada came and went, with spot gold eventually setting its weekly high just after midnight on Friday. North American traders went to bed Thursday night expecting Friday morning's non-farm payrolls, NFP, report to be the week's highlight for gold. But the People's Bank of China, PBOC stole the spotlight in the early hours, announcing at 4 a.m. EDT that they had broken their 18-month streak of sovereign gold purchases in May and sending metals prices crashing through multiple levels of support as algorithmic stop-loss orders were filled in rapid succession. Spot gold sank like a stone, with much of the move taking place in a matter of minutes. Then the yellow metal was in the moments before the 8:30 a.m. release of the surprisingly strong U.S. jobs report, which drove gold down even further as markets recognized that the Fed would have even less reason to cut in the near term. As gold was already down over $40 at that point, the NFP took the yellow metal all the way down to support. Now we'll show you the best clips, but first smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Would be much better answering this question than I would be, but I'll tell you why I did it. So, here we are. We started selling ounces, to the retail public in 2008. And that business built over time, and it's something we're very proud of. We're the only company that, actually uses our own silver, ships it out from Mexico, gets it refined in the United States, produces a retail product, has an e-commerce website, and sells our product, on the internet. And it's been going on for some time. So a couple of years ago, after the whole COVID situation, when the interest came into the metal during the Reddit squeeze and all that, and then even since then, the demand for physical retail products has increased substantially. It fluctuates, of course, and it's and I listen to your podcast all the time, and I listen to Andy all the time, and I know it's the premiums move around and the demand moves around, but nevertheless, the demand is there. And yet the mints would not supply us with the demand that we wanted, and we had demand that probably was 200 to 300 times, or 2 to 3 times our demand, or what we could sell, what the mints would be able to produce for us, and we could turn around and sell it to our customer base. And it was getting more and more frustrating. And I said, a year and a half ago, hey, look, let's just do this ourselves. And we got a building, we got the staff, we've got all the equipment, and we just started production literally 2 months ago. We're only producing 3 products currently: a 5-ounce ingot bar, 10-ounce ingot bar, and a 1-ounce kilo bar. It's under the name First Mint, a Nevada-based company, and we're super proud of it. We're only budgeting a couple million ounces to go through that mint in the first year, because there's growing pains and all the things that you have to go through to get it ramped up. But my goal is to get 100% of our silver ounces produced through that mint. And I'd also like to convince, Coeur and Hecla and many of the other mining companies out there to also put their ounces through this mint as well. And the whole rationale behind that, as because you interview tons of people and you're knowledgeable about this space, that there's a leverage in the system of somewhere around, we don't know exactly, but call it 300 to 1. There's something like 250 trading days in a year. Silver paper markets trade something like 1 billion ounces a day. So that's a call. Just round it up to 300 to 1. For argument's sake, we produce 10 million ounces. So 300 times 10 million is 3 billion ounces. So we know the banks leverage our 3 billion ounces, right? Or our 10 million ounces are leveraged to 3 billion paper ounces. So the banks know they're getting our physical metal, and they leverage that in the paper markets because they know it's coming to them, and they know when it's coming to them because we put out public announcements, and the entire mining sector does exactly the same thing we do. So the banks know how much gold's coming into their vaults. The banks know how much silver is coming into their vaults, and they hedge that in the paper markets, which creates this whole, manipulation, if you want to call it, and I'm not sure if that's the right word, but it's basically managing their book, I think, is probably the best way of putting it. But nevertheless, it has this constant supply of paper that's being put into the paper market. So during a Reddit squeeze, which did occur, there was a ceiling on the paper market because the banks knew the physical was coming in, and they were happy with the price, and they put a lid on the price in the paper markets. And then next thing you know, the buying dries up because the banks are bigger than the paper buyers. And of course, they know that once the buying dries up, this price of the paper market's going to drop, and they're just going to sit there and buy back all the paper. It's just such a wonderful game, and they love doing it. And they, so what I'm trying to do is pull off those ounces. So if I can pull 3 billion of paper silver ounces out of the market, it's not a lot compared to the amount trades on an annual basis, but at least it's the beginning. And my mission in life is to try to pull as much paper silver out of the market as possible.
What do you think of Keith's take? Will more permits increase supply over the next 18 months, or would rather the inefficiencies at the administration create a massive big bank silver squeeze? Post in the comment section down below your honest opinion. Now watch this video right here because it's a perfect fit for you. I see you on the other side.